Hey guys, welcome back to another episode of Andrew Invests. On this channel, I share weekly updates of my portfolio holdings and the total valuation of my holdings. I like to be open and transparent with all of my investment choices, so I show you every single investment that I hold, whether it's in the green or in the red. That's different to a lot of YouTube channels, which will show you their holdings when they're doing well, but as soon as they start to tank, they will conveniently be forgotten about. So that's not me. I like to show you everything I have, whether it's positive or negative. And today in this episode, I want to go through some of the key investing and valuation terminology that I've mentioned previously in previous episodes, and effectively show you how to pick a good company to invest in based on my own some valuation metrics that I use personally. And hopefully you guys can learn to use those metrics to pick good stocks of your own and invest in something that you have faith in.
Let's start off with another portfolio update. As you can see, it's been another good week for stocks, with my active portfolio actually significantly outperforming my passive portfolio for the third week running. In total, I've made gains of £2,700 or $3,300. So I'm pretty happy with those returns, as you can imagine. With earnings due to be published in the next week for some of my major holdings, plus the Fed rate decision, I'm sure there'll be a major change in the portfolio by next week, whether that's for positive or negative. Although I had previously predicted negative earnings, so I'm braced for the worst. So the main positive drivers in my active portfolio over the last week have been big tech stocks. So Apple, Google, Microsoft, and Amazon. They've continued to perform well on previous news of lowered inflation and hopes of better than expected earnings. Some of this have been driven by Microsoft, who reported last week with poor earnings, but they actually outperformed some of the poorer forecasts that had been predicted by analysts. I only hold a small amount, but I have faith for them in the long term. Meta, Apple, Google, and Amazon are all reporting this week, so that will have a huge effect on whether these stocks will continue their recent momentum. I'm aware that some of you may be beginners or new to investing. I use a lot of investing terminology in my videos, so I want to explain what some of the words mean. And I also want to take you through the basics on how to value a company, how to tell whether a stock is overvalued or undervalued, and what makes it worth investing in the long term. Now, I think a key piece of information that people often get wrong with share prices is thinking that the total share price of a company, if it's larger than the share price of a different company, that means that this company is more highly valued than the other company, or it's somehow a bigger company, right? So some people would think that if Meta is worth $150 and Crocs is worth $120, Crocs is maybe 20% smaller of a company than Meta. Now, that's not the case. Think of a share as a slice of a cake, with the cake being the size of the total company. But the size of a slice may vary massively. So this slice of Crocs may be far bigger a portion of the cake than it is for Meta, and that is actually true. So what we can actually use as a much better metric for valuing the total size of a company is the market capitalization here. And that basically is just the share price times the total number of shares outstanding in the company. And that gives Meta a total market cap of nearly 400 billion. In the case of Crocs, even though the share prices are quite similar, the market cap is only 7.5 billion, which is a huge difference. And that's basically just because the shares of Crocs is a much larger percentage of the company, although still a very small fraction. So that is definitely worth remembering. Now that we know what the market cap is of a company is, we can go through the price to earnings ratio, or the PE ratio. So this is a quite crude measure of valuing a company, but it is useful in just taking a brief glance at a company and figuring out how it's valued by the market. So the PE ratio is basically just the market cap divided by the previous year worth of earnings combined, so the net income of the company. So in this case, you would take these 4 quarters of income and add them together. Then you would do this divided by that, and that gives you a PE ratio of 13.29 for the trailing 12 months TTM. Now this here means the forward earnings of based on the forward earnings of a company. So you've got lots of stock analysts who generally look at companies and kind of try and predict how much money they're going to earn over the next year or so. And what the consensus for analysts is that based on those earnings numbers and then this divided by those earning numbers, that the ratio will be 8.86. So they're forecasting quite a lot of growth in income compared to this year. I mean the last 12 months. Now, what we can use, one of the things we can do with the PE ratio is compare it to the average PE ratio of the S&P 500. The S&P 500 is a composition of the shares of the 500 largest companies in America by market cap. As we can see, the median PE ratio of the S&P 500 is 14.9. And by comparing a company's PE ratio, for example, Crocs, which is 8.86 to that, we can see that the market is currently valuing Crocs' growth potential as less than the average S&P 500 company. If it was the same as the S&P 500, i.e. 14.9 or whatever it was, the market effectively values this company's growth potential as the same as a S&P 500, the average S&P 500 company. Now, this is only a very, very crude and rough measure, but if you want to eyeball a stock, you can always look at it in this way. By looking at the forward price to earnings ratio of Crocs, you can see why I think it's an undervalued company. The price to earnings is only 8.86, far lower than the 14.9 of the average S&P 500 company, which means that the market is effectively pricing in less growth for this company than the market in general. Now, I don't think that will be the case. If you look at the income growth of Crocs over the last 10 years, it's been 14.15%. I know that Crocs is particularly popular with Gen Z. I see a lot of people wearing it. I've seen a trend in that way in fashion for a while, and I really think that 2023 the trend will continue. So I don't think that Crocs should be valued this low. As a counterpoint to Crocs, let me show you another company that has a low price to earnings ratio, and yet I don't think this company is undervalued. So General Motors, it's a company that's been around for a very long time, has created pretty much consistent earnings, profits over the years without very much revenue or earnings growth at all. Revenue. So when this company is rated at only 6 price to earnings, I think this is fair enough because there's very little growth potential to this company. In the case of Crocs, I think there's a lot more growth potential, and with a forward price to earnings of only 8.86, it's very, very low. Now, if we want to talk about a more precise way of valuing a company, we can actually use some more metrics such as return on capital employed and earnings growth. So ROIC, or return on invested capital, is very similar to return on capital employed. They're effectively the same thing, and they're both really useful metrics, and they're basically used to measure the profitability of a company. So effectively what it means is if a company has a 10% ROIC or ROCE, it basically means that for every dollar that that company has, it is able to produce 10 cents per year of profits or earnings. So the higher the ROIC, the better. And obviously with earnings growth, the higher that, the better. Now, this is a really rough table, but effectively you can use it to roughly measure the price to earnings ratio that a company should be at. So, for example, if a company has a 4% ROIC and a 4% earnings growth, that PE ratio should be about 7.1. Whereas when you ramp that up to 24% return on invested capital and 10% earnings growth, you can see that that company hypothetically should have a PE ratio of 25.7. And if we see a company with those statistics and a lower PE ratio than that, we can generally assume that that company might be undervalued. And vice versa, if it's above that ratio, we can probably assume that it may be overvalued. Now, how does that relate to the companies I was previously showing you? So Crocs, for example. If we look at the ROCE of Crocs, we can see that over the last 4 quarters, if we add these numbers up, so 17, 23, 30%. So Crocs has had a 30% ROCE over the last 12 months, and it's had a earnings growth over the last 10 years, so annualized, of around 18%. If we put that into our graph here, it's way off the chart, actually, on both sides. So ROCE of, 30%, so it would be somewhere around here, and the earnings growth way down here. So that PE ratio should be a lot higher. Right now, the company is priced at, a 13 trailing 12 months PE and an 8.9 forward PE. So for the previous last 12 months, it's rated around here, only 8% ROCE, and earnings growth, any of them, I guess. But obviously, this company is seems undervalued by this measure, at least. If we look at another company, such as Nike. Now, Nike has a price to earnings ratio of around 36 for the trailing 12 months and the next 12 months. So what we should expect from here is an extremely high ROCE and also really high earnings growth. Now, let's see if that's actually the case. So if we look at the ROCE, we can see it's 5 for the last 12 months. It's 5, 11, 16, 21. So the ROCE is 21%, and the earnings growth over the last 10 years has been about 10% annualized. So if we look here, the ROCE was around 21%, and the earnings growth was 10%. So if we go by this measure, the PE ratio should be somewhere in between these two numbers. So let's say 23.5 or 24. Now, if we actually look at the PE ratio of the company, it's a lot higher than that, and that would suggest that the company is overvalued. However, that ratio doesn't represent a complete picture of the story. It doesn't represent Nike's brand value and stability in harder times. And you know, there's not always there's not always going to be one measure which really easily defines whether a company is over or undervalued, and you really have to go through a lot of other measures too. But that's a measure I really like to use, and I've used for some of the companies I've invested in, and I really hope that helps some of you understand some of the basic investing terminology and valuation metrics that I've been using. Let me know if you have any questions in the comments, and hopefully you'll join me on the next video. Speak to you guys soon.